Good evening, guys, and welcome one last time to P2 Corporate Reporting. As you know, my name is Martin Jones, and this is the London School of Business and Finance, the interactive product. I am here tonight to talk to you about financial instruments, but you know the game. I have some slides behind me here that I'm going to reel through just to reinforce where we're at and what we've done. So here I go. I'm going to mini-me myself into the corner. There I go, sucked into the corner with the introductory slide just there, proving that I really am Martin Jones, and there is my email. Use it as much as you like. You know, do correspond. Please feel free to do so. Where are you, fella? You're over there, are you? There we go. Got some clever technology going on at the moment here. Over my shoulder, there is the first evening. We did basic groups, guaranteed marks in the examination for your pedal, saddle, handlebar. Of course, there's going to be more to the P2 examination than just the very basics of groups, but all groups questions are based upon basic groups. And you know, your pedal, saddle, handlebars, where it's at, make sure you're rock solid with that. Wonderful subject of complex groups, which I particularly like in the context of the question Ronette, which is recorded in the library. Make sure you do Ronette. Oh, sorry, I went a bit fast there. Foreign currency. I'm feeling that this winter. I really am. Foreign currency. There's an excellent homework question highlighted there called Extreme. Really lovely question. Then we move on to cash flow statements. It is a bit unfortunate, but cash flow statements is a on-off switch. Either it does come or it doesn't come. If it does come, it's 35 marks. If it doesn't come, you've wasted your time practicing it. It is unfortunately like that, but you have to make sure you can do it. And you can see on the homework over there, I've got Squire listed. In fact, the question we did in class was called Ducky. Make sure you can do both of those. Moving into the solid financial reporting, you know, performance reporting, provisions, non-current assets, leases, and, you know, ramping it up a little bit, employee benefits and share-based payment. That's kind of the middle of the course. And then finally moving on to the rocket science for tonight. Yep, this is evening 8, and we are going to do financial instruments, and it's the last evening, and we're done. Kind of, anyhow. You might recall me telling you that I am seeing you again for one last session, the mentoring session, which is not tomorrow Friday, but a week tomorrow. And it's half an hour long, and half of that half an hour, 15 minutes, I'm going to utilise to do deferred tax. The examiner's attitude towards deferred tax has really decreased in the last couple of years. It's a very complex subject, and one could, you know, spend 16 hours just doing deferred tax, to be honest with you. But because the examiner examines it every other exam, roughly speaking, so probably with 4 sittings a year, you're expecting it, you know, twice a year. Twice a year for 2 marks is roughly where it's at in terms of deferred tax. So not a biggie, so we shouldn't overplay it. So what I'm doing is I'm making sure I spend the whole evening on financial instruments because, you know, after groups, this is the biggest subject. Even, you know, it's you could even argue it's even ahead of groups. You know, groups is a massive subject, and this is almost as big. And it could actually be slightly bigger depending on how, you know, the examiner plays with financial instruments this winter. Enough chat. Let's start. What I'd like to start is with a bit of chalk and talk, and that is exactly what I'm going to do. So I'll just pick up my pen and flick to a blank Windows channel. There's channel, and off we go. And I'll say my highs to everyone. Wonderful to see you guys corresponding already. I look forward to your questions this evening. I had a very strange Tuesday afternoon session in the Tuesday afternoon gone where no one corresponded with me at all. That was a strange experience, and I was really missing you guys. So I'm looking forward to all your questions over the next couple of hours. Let's start. So here we go. Let's start with what a financial instrument is. The definition. Financial instruments. FI. FI. FI are contracts that create an asset in one entity and a liability or equity obligation in another entity. There we go, we're off. Lovely. And that is the definition of financial instruments. But there's a really nice way of translating this. You probably do need the definition, you know, it's one of the few definitions that you probably do need, but you probably do need that one. But you also need a translation of that definition because it's quite techy. So let's have a translation. FI are deals with a counterparty. That's eloquent, isn't it? Very punchy. And I'm going to be a little bit naughty. Here's my class notes. I'm actually going to destroy the class notes. Naughty mate. Ah! I'm going to pull off a page. Another really nice way of saying this, which is even more dumbing it down, is a financial instrument is a piece of paper with a face behind it. It's a piece of paper with a face behind it. And there are 3 blocks of financial instruments, and it can be useful, kind of, comforting to know that you are familiar with financial instruments even before you start. You are, you know, you are. Here's some languages from financial management, from capital markets, from, you know, general business. There are 3 blocks. There are 3 blocks. Oh, 3 blocks. I missed the word blocks. There are 3 blocks. Oh, goodness me. What's up with me? Of FI. Essentially. And hopefully these phrases are familiar to you. Debt. Equity. Equity. And derivatives. There you go. Debt. A classic example of debt is a sales invoice. And I think I'll make you the guy doing the selling. So you sell to me and present me with a sales invoice. When you look behind your sales invoice, there's my face. Okay, so that would be a debt asset for you and a debt liability for me. More usually known as a trade receivable and a trade payable. But yes, it's a debt asset for you and a debt liability for me. Same piece of paper, but 2 faces. Equity, e.g. ordinary share, or ordinary shares if you prefer, ordinary share. Should we say it like that? Ordinary share. Piece of paper. Bacha! You take a slice of my pie, and in exchange I issue with a piece of paper. But behind the piece of paper, there's me, the incorporated entity. I have an equity obligation to you, and you have an equity asset. Derivatives, e.g. gold. Bet. I bet on gold. You bet on the price of gold rising, and you bet with me. So I bet on the price of gold going down. And I'm wrong. And you're right, because the price goes up. Therefore, you have the asset. And the asset is represented by, yep, here it is, a piece of paper. And when you look behind the piece of paper, there's me, an IOU. You have a derivative asset, and I have a derivative liability. But why is a derivative called a derivative? Well, what we've done, both of us, is we've bet on the price of gold. What we don't hold is gold. We both hold a piece of paper. But the value of the piece of paper, your asset, and indeed my liability, is derived from the price of gold. And when an asset derives its price from the price of gold, when an asset derives its price from the price of gold, it's called a derivative. It's also called a bet, you know. The words are completely interchangeable. The word derivative makes it sound very fancy, but a gold bet is not a complicated thing. There you go, guys. That's it. But did you notice something that I did there? What I did was I pushed the asset onto your side each time. And the reason I did that is because that's the way the examiner does this subject of financial instruments. I'm not expecting that you have done F7. In fact, I'm expecting you haven't done F7. But if you have done F7, you'll probably recall that when you're doing F7, most of the F7 questions look at the bottom of the balance sheet, they look at the liabilities. It's just the way that P2 is, it looks at the top of the balance sheet. So waiting for you in your examination, there could be 5 financial instruments, all of them financial assets and 0 of them financial liabilities, which naturally leads to a focus this evening on financial assets, starting now. I'm going to take you into the class notes where there's a flow chart for you to learn. I'm going to start by going into my paper copy, that's easier for me. So we're right at the back now, we're in chapter 12, aren't we? Chapter 12, I can see there's chapter 12. So the intro to chapter 12, or should I say the front page to chapter 12, is on page 151. And there's a little intro on page 153, but what I want is on page 154. So I'm just going to skim off to page 154. There's the notes. Just going to stick it in because it's quite a nice way of doing it. 154. Press go. Pacha! And then we have financial asset classification summary. Financial asset classification can be summarised by using this flow chart, and there is nothing at all simple about this flowchart. It is a complex flowchart, for sure it is. So much so that I don't really want to do very much with it other than drag you on a couple of pages to the first question. The first question that we're going to do together is on page 157. Can you see the question John? And next to it is the question Travolta. Before we get into these questions, I want you to look at the title and I want you to do some cheating. Can you see that the title says amortised cost? I just want you to grab hold of that phrase, even though you don't know what it means yet. I want to grab hold of that phrase and use that within your notes. So off we go. We're going to go and have a look at FA carried at amortised cost. Oop. Goodness me, spelling's terrible today. Amortised cost. We're going to have a look at FA carried at amortised cost. Now, I'll highlight it again. You can see that we've used the phrase amortised cost, and that phrase, we don't know what it means yet, but that phrase was used on the flowchart, and I will take you there and show you. So back to the flowchart. Up we go, up we go, up we go. There it is, here it comes. Now, you can see over my shoulder that there's 2 circles here. The 2 circles at the bottom are amortised cost and fair value. Fair value, as you know, from what we've been saying so far, is always abbreviated to FV. Annoyingly, amortised cost is not abbreviated to AC, which is really irritating. It'd be great if it was, but it just isn't. So amortised cost. Now, what we've just written in our notes is amortised cost. So we know for a fact that we're on the left. We know for a fact that we're doing amortised cost. Which means, therefore, there must be a yes to the first question and a yes to the second question. We have absolutely no idea what these two questions are asking, but we know that there must be a yes to these two answers. Because the way it works is when you've got a financial asset, you ask these two questions. If you get two yeses, you get amortised cost, and if you get one no, you get fair value. So I'll just say that again. As soon as you've got a financial asset, you have to do these two tests. And if you get two yeses, you get amortised cost, and if you get one no, you get fair value, and that's the game. So let's play the game together, and let's play it as a game because it's quite challenging, this, and I want it to grow on you. So off we go with question John. And we don't get very far before we stop. So back into the notes again, but this time into the question John. Can you see question John says the above buy? Stop there. The word buy indicates an asset. I wish I had bought myself a coffee before coming into the studio, because that coffee would surely be an asset. Something that you buy is an asset. Oh, so we have an asset. Oh, in that case, we need to do the two tests. What are the two tests called? Well, they're called the cash flow characteristics test and the business model test. But how do they work? Well, I don't really know. But we know we must have a yes to both of the tests because we're in amortised cost. Okay. Okay, that's the deal. All right then, let's do it. Cash flow characteristics test. So we don't fully understand the test yet, but we know we must be getting a yes. Yes, this is a simple loan asset because yes, 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 yes. In order to get one overall yes, we need 3 sub-yeses. In order to get one overall yes, we need 3 sub-yeses. Yes, yes, yes. Here are the 3 sub-yeses. Yes, there is principal cash flow. Yes, there are interest installments cash flow. And yes, there is nothing else. And it's quite a tricky test. So what we'll do is we'll start at the back end. What we're going to do is we're going to read the scenario for John and see if we can see the word options. If we can see the word options, it's a fail of number 3. So what we're looking for is the absence of the word options. In other words, we're looking for no options. We're looking for no options. We're looking for the absence of the word options. Now don't read the scenario properly, just scan it. The above buy debenture off the market with normal value 8,000. Coupon rate is 1%, but the market demands a return of 8%. The loan is 4 years to run. The intent of the investment to maturity. Okay, haven't understood that, but I know that I've not read the word options. Good. Okay, we have a tick to number 3. Now going back to 1 and 2, which are kind of together, there's principal cash flow and there is interest instalments, and we did actually see those in the scenario that we just scanned at speed. So we'll go back to it and take our time this time. So I'll get rid of the orange so that I can get into this. The above, that's John, buy a debenture off the market with a nominal value of 8,000. That fella there is often called the nominal. It is often called the nominal in the capital markets. But IFRS 9, the financial reporting standard, calls this chunk of money the principal. And what happens is these guys are going to give us 8,000 back at the end. The coupon rate is 1%. Can you see that 1%? And the way that this standardized lending piece of paper works is that it pays 1% of 8,000 for each year that it lives. So 1% of 8,000 is 80. Keeping on reading now, the coupon rate is 1%, but the market demands a return of 8%. The loan has 4 years to run. What that means is that there are 5 cash flows. The 5 cash flows are 80, 80, 80 and 80, and with the final 80 we get 8,000. The name of the individual 80s is called interest instalment, and the name of the big chunk of cash that comes back to us at the end is called principal. So yes, we have both of these. So yes, there is principal cash flow, that's the 8,000 flowing back to us at the end. And yes, there is interest instalments. There are 4 times 80. There are 4 instalments of 80. Wow, that was quite a start, wasn't it? So that gives us one of the 2 yeses. We need a yes to the cash flow characteristics test, and we need a yes to the business model test. So let's do the business model test now. Here we go. Business model test. Yes, this simple loan asset is held on a collection basis. Which means intent to keep, rather than a speculation basis which means intent to trade. Now, before we get into this, what's happened is let's have the 2 of us together, working together, okay? So you and me, and the guy that we've lent to is just out off screen, okay? So this is the deal. We've lent to some guy who's just off screen, and we have a piece of paper representing his obligation to us, our asset, okay? And when we look behind the piece of paper, there's his face, okay? Now the piece of paper doesn't change when these 2 change. What changes is the content of my head, okay? If I have this piece of paper and I intend to sell it, it's called the speculation basis that is in my head. If I have this piece of paper and I intend to wait and collect the money, then that psychology is called the collection basis, okay? So the piece of paper doesn't change, with the business model changes. What changes is the content of my head. It's all about what I'm thinking, okay? So this is a test of the content of my head. But I've already said yes, this simple loan is held on a collection basis. How can I be so sure that it's on a collection basis rather than a speculation basis? What data do I have in the question? Well, let's go back to the question and see what we have. The first thing to notice when we strip out the yellow is that I'm going to go crazy and highlight it in pink. Can you see this word here? There is a market. The above buy a debenture off the market. If we buy it off the market, we can sell it back into the market. Okay, you know, we can. But it's not whether there is a market that counts, it's whether we intend to utilise the market, which we don't. When you read right to the end, it very clearly says the intent is to hold the investment to maturity, and therefore I am having the speculation, and therefore I am having the collection basis as my psychology. So I get a yes to the business model test. Yes, this asset is held on a collection basis rather than a speculation basis. I get 2 yeses, and therefore I get amortised cost. So this is going to be carried at amortised cost. I'm just going to go up to the flow chart now and put 2 ticks, just, you know, to reinforce the idea. It's overdoing it a bit maybe, but I'm feeling it, so here we go. I get a tick to this fella, I get a tick to that fella, therefore I get this fella called amortised cost. But what does amortised cost mean? That's a good question, isn't it? Because it's not obvious what that means at all. So, conclusion, amortised cost. So the FA, abbreviations are completely fine, financial asset. So the FA is carried at amortised cost. So the FA is carried at amortised cost, meaning discounting and unwinding. Whoa. I'll turn that into a comma there we go. Meaning discounting and unwinding. And you've guessed the next thing that we do is the discounting and then the unwinding. So discounting. Here is the DCF. Here is the DCF, the discounted cash flow. The DCF, the discounted cash flow. And just make sure I've got enough space here. I'm going to spread myself out a little bit. But usually a DCF is worth 1 mark in the exam, which is a bit shocking, isn't it? And therefore more abbreviation is needed. So we have years, 1, 2, 3, 4. We have cash flow, discount factor, and present value, which you certainly don't write in full. Excuse me. This one time I'll write it in full. There you go. Now, we've actually looked at the scenario already and identified the percentage of 1%, which gives us the coupon rate. We use the market rate as the discount rate. Okay, so you always use the market rate as the discount rate and the coupon rate as the cash flow rate. It's always the case. But there's you know, what you're looking for is the phrase coupon rate and market rate and allocating it in the right position. But there's a nice little shortcut that works really well, and I use it all the time. And that is, you know, when you're working at speed, it can be really helpful to identify that it's the smaller percentage that gives us the cash flow, and it's the bigger percentage that we use for discounting. There's no fundamental reason why this is the case. It's just the culture in capital markets. It's the way capital markets work. And that is the way that they flow, the way that they work. So the smaller percentage was 1%, and 1% multiplied by 8,000 gave us 4 instalments of 80, 80, 80 and 80. And then the final big cash flow called the principal flowing at the end was 8,000, giving us actually 5 cash flows that look like 4. And then we need to generate these things called the discount factor to allow for the time value of money. Of course, the thing is about each dollar that appears in the third 80 is it's more distant from us than the first 80 and therefore is worth less. It's got less value. And the trick that we use to accommodate the time value of money is called discounting. And if you've studied this before, it's great, but you've almost certainly studied it before using tables. Now you have to use your calculator. It is very rare for the examiner to actually give you tables. You have to work out the discount factor itself. Now, if you're used to using calculators, you probably know lots of shortcuts and lots of speedy ways of using a calculator to get the figures, in which case, go ahead. You know, this is not for you. But for those of you who are less familiar with generating discount factors using a calculator, here is one way of doing it. You remember the bigger percentage is 8%. So you go 1 divided by 1.08 equals 925, or 926 actually. So 926. Then keep the 926 in the dial and divide by 1.08 gives us 857. Keep the 857 still in the dial, divide by 1.08 gives us 794. 794, and keep the 794 in the dial and divide by 1.08 and get 735. Okay? So for those of you not sure about that, let's do it again. Clear, 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 clear. Then 1 divided by 1.08 equals, the first year is 926. Keep the 926 in the dial. Then press divide. 1.08 equals 857. Keep the 857 in the dial. Then press divide. Divide 1.08 equals 794. Keep the 794 in the dial. Then press divide 1.08 and you get the last year 735. Okay? There's loads and loads of different ways of generating discount factors, and if you're good with calculators, and especially if you've got some statistical calculator, you're free to use whichever method works for you. So 80 times by 0.926 equals 74 approximately. 80 times by 0.857, oops, 80 times by 0.57, oh dear me. 80 times by 0.857, 69. 80 times by 0.794, 64 roughly, and 8080 times by 0.735 gives 5939. Approximately 5939. That 5 is not very good, is it? Just clean that up a little bit. 5939. That's better. And then we add them together. So 74 plus 69 plus 64 plus 5939 equals 6146. 6146, and that's the answer to the question. It's technically called the initial fair value, is the technical name of that product. It's called the present value as well, isn't it? In financial management it's called present value, but in financial reporting it's called the initial fair value. And it's the answer to the question. This question is so challenging that I didn't dare read the requirements, but I will now. Let's have a look. Comes in 2 parts. The first asks us to calculate the amount that the company would be prepared to pay for the asset. This is the answer. This 6146 is the amount that the company would be prepared to pay for the asset. This 6146 is the amount that the company would be prepared to pay. For the asset. But this language that I've utilised here is very much the faceless language of capital markets, and it takes away the underlying substance. So what I'd like to do is to translate that, and hopefully that'll, make it clearer what's going on. I'll reinforce it as well. This 6146 is the amount the lender lends to the borrower. That's it. It is the amount that the lender lends to the borrower. So we're going to lend 6146 to the borrower, who will pay us back 80, 80, 80, and another 80, but with that final 80, 8,000 at the end. Whoa, that's a lot more than the 6146. Why are they giving us so much more? Interest. They're paying us interest for the time value of money. Which brings us back to the question, and the final answer, the real accounting. To be frank with you, all we've done so far is financial management. The next question is, show how the financial asset, would be accounted for over the 4 years. That's the real financial accounting. So here we go. Here's the real financial accounting. Off we go. This process is called unwinding. Unwinding. Then the receivable unwinds as follows. Then the receivable unwinds as follows. Years 1, 2, 3, 4. We have an opening balance, and we have a closing balance with interest accruing and instalments being paid, like so. There's a particular way that this table is generally utilised. What we do is we pin the table down at the two corners with the two principal flows. Actually, there's two principal flows. There's the 6146 that we give to the guy, and the 8,000 he gives us back at the end. So we pin the table with those two fellas, which is 6146 and 8,000. And then we'd stick in the instalments of 80, 80, 80, and 80, and then we unwind at 8%, which means we add 8% to the asset for each year that flows. So 6146 multiplied by 0.08 equals 492, and that accrues on top of the 6146, so plus 6146 minus 80. They pay us 80, so we have 6558, if I'm reading that right. 6558 multiplied by 0.08 gives us 525. So 6558 plus 525 minus 80, because they give us a chunk of cash to reduce their liability, reduce our asset. 7003 multiplied by 0.08 gives 560, so 560 plus 7003 minus 80 equals 7483, so 7483, 7483, and then we multiply by 0.08 and we get 599, and you can see if we drop in 599, we can do that actually. Let's drop in 599, so 599, so it's 7483 plus 599 minus 80 gives us, oh, a little bit too much, there's a rounding error, and you can literally leave your answer just like that. The more usual culture is to lose the rounding error of 2 in there, and there we go, and that's the answer. Wow, what do you think of that, guys? There we go. Financial instruments, financial asset accounting. No one ever said that was easy, did they? Challenging stuff. Any questions so far? I've blasted you all into silence, I can see. But I think it's a good thing. I think the lack of questions encourages me to think that you're ready to try again. That was not easy. Let's do it again. Well, we are going to do it again, but not in its entirety. We are going to do it again, but not in its entirety. We're not going to do the first 2 tests again. We're going to repeat the numbers. And the reason that we're doing what we're doing is because of what the examiner does. It's really, really annoying, but we have to cope with our examiner, and our examiner sometimes does things that are not great. And I'm hoping this won't happen to you. It hasn't happened for a few years, but sometimes the examiner forgets. Yep, sometimes the examiner forgets. And if he forgets, we need a solution to the problem. Examiner. Sometimes the examiner forgets to tell us the intent, or to tell us the intent. And of course, once you have a financial asset, you have 2 tests that you must do. You've got to do the cash flow characteristic test and the business model test. And if you were doing a financial asset in real life, and in real life the accountant forgot to tell you the business model, then what you'd do is you'd go back to the Treasury guys and ask them, what business model do you have? Because the answers to that question would result in amortized cost or fair value. So we actually have to know this information. And in real life, you would just stop if you discovered that you had this missing information and go back to Treasury and find the information, because you can't do anything without that information. But hang on, you can't just stand up and go and ask the examiner in the middle of an exam. You have to cope. And although it is a pain in the backside when the examiner does this, the coping solution is not too bad. See what you think anyway. Sometimes the examiner forgets to tell us the intent, and then we do this, which is 1. If fair value is given, then we use fair value, fairly obviously. But more subtly, if fair value is not given, then we use amortized cost. Now you can see that I've deliberately written the 2 questions, John and Travolta, as a pair. And if you kind of unfocus and then look at the 2 questions next to each other, you can kind of instantly tell what information is missing from the second one. I'll just get rid of the colour because it's very distracting. But if you look at those two questions, you can instantly see what's missing. What is present in the first question, I'll highlight it in pink, is this intent here that is very clearly absent there. And in real life, if you were missing the intent, then you wouldn't be able to answer this question. You'd have to go and find the intent before you did anything. But we're not in real life, so what we have to do is we have to cope. Now, skimming Travolta, you can see that not only is the intent missing, but there's no fair value either. Fair value has to be given, and it'll really jump out at you. You won't miss it. So just skimming this, we can instantly see there's no reference to fair value. Therefore, we're going to use strategy 2. Question Travolta. We use 2 above. Which therefore takes us into discounting and unwinding. Discounting and unwinding, which we're going to do now. We'll come back to your questions in a moment. So I've got enough space for the, I'll do the discounting right here. So discounting. Here is the DCF. Years, cash flow, discount factor, present value, 1, 2, 3. So we're doing Travolta, aren't we? And we can use this trick with the percentages. You remember the idea? So the smaller percentage. Oh, I'm missing the T. Smaller percentage there. Bigger percentage here. We just have to scan the scenario to see the 2 percentages, 2 and 7. So the smaller percentage is on the left. 2% of 1,000 gives 20. Can you see the life of the loan is 3 years? 3 years. So the cash flows from the borrower are 20, 20, 20, 20, 20, 20, and with the final 20 comes back 1,000 at the end. So the cash flows are 20, 20, 20 and 1,000 at the end. Then we do our discount factor using whatever trick that you want to use. I'll just reinforce the baby version. 1 divided by 1.07 equals 935. Keep the 935 in the dial and divide by 1.07 to give 873. 873. Keep the 873 in the dial divided by 1.07 gives 816. Just to say it again, if you're good with calculators and you can do shortcuts, please use them. So we get 19, 17 and 1020 times by 0.816, 832. So 19 plus 17 plus 832 is 868. So initial fair value. So the initial fair value which we then slot into the unwinding. the receivable unwinds as follows. Usual story, we pin down the table with the two big cash flows called the two principals, and then the instalments we slot in a column, and then off we go. So we're multiplying by 7, we unwind at 7%, so 61. $64. $67, yeah, that's nice. Which I seem to have added across wrong. I'm useless with calculators. Oh, there you go. Bang on. Lovely. Perfect. And this one balances without any need for a rounding adjustment. It's quite unusual, actually. Usually there is a rounding adjustment. Let me say a couple of things before we go any further with this. This is very similar to leases, isn't it? You can recognise that we're using what you probably think of as being the leasing table. Actually, it's the other way around. The leasing is using the unwinding table. This table applies to all forms of financial asset, not just leasing receivables, but also applies to lending receivables. And, you know, if you had it'd be rather unusual to have a very long-term trade receivable, but if you had a very long-term trade receivable, it would also do this as well. So in fact, all receivables do this. It's the leasing table, but it's properly called the unwinding table. But the reason I'm referencing leasing is because you recall that when we're doing leasing, the examiner just examines 1 year, and frankly, without exception, the 1 year that he examines is the first year. So the first little benefit that we get is that almost always the examiner examines just 1 year, and that 1 year is the first. And that does, you know, save us a few seconds. It's not a massive difference, is it? But it is a difference. So this is the data that we really need, and we're actually finishing this fella off just to give ourselves confidence in the process. And generally speaking, this is examined in the B section, in which case the answer would look just like this. But if the examiner wanted you to take the data and, you know, slot it into the FS, then the way it drops in is really nice. I think you'll like this. Is blue a good colour? I'm going to try this light blue. How does that look? Oh, it looks quite nice. Yeah, quite a nice colour. Sometimes things look different on my screen to yours, but I can see your version of it. It's looking quite nice. It makes perfect sense. The balance drops into the balance sheet, the cash flow drops into the cash flow statement, and the income, the interest income, goes into the income statement, otherwise known as the P&L. But here's the little sting in the tail. All of this is the receivable. Of course, we're looking at it from the point of view of the bank, and you've got to be careful here to make sure you're consistent with that. So the financial asset is an asset. The cash flow is an inflow, and the P&L, that is indeed income into the income statement. Cute, isn't it? So if the examiner asks you for a P&L, then you slot the number for the P&L into the P&L. If he asks you for a cash flow statement, which is hot, isn't it, then you slot the 20 into the cash flow statement. And if he's asking you for a balance sheet, then the 909 goes onto the balance sheet, okay, as an asset. Which brings me back to Swishy's question. Swishy's question was, how many marks do we really get? 4 marks for that fella up there? The answer is yes. The examiner has examined this before and given that tiny little marking allocation. If I can show you what he did. He's examined this on a few occasions, and you know there's a little bit of variety here. But going back to John, the marking allocation, the very ungenerous marking allocation, I think I might use this little fella, was 1 mark for the cash flow characteristics test, 1 mark for the business model test, 1 mark for each of the tests, 1 mark for each of the tests, and 1 mark for each of the tables. 1 mark for each of the tables. It's not very much, is it? So yes, you certainly have to be quick with this. But just to reinforce, it was 1 mark for the 2 tests, 1 mark for the 2 tables, but when it came to the table, you only had to do the first year. So that's, you know, that does make a slight difference, doesn't it? Yep, but 4 marks. There you go. Yeah. It's a really nice question there up on the board, and I'll read it out to you. And you'll know, if you watched last week's video, you'll know exactly why it's been asked. I'll go in. There we go. There we go. I'll get rid of the colour there because it's very distracting. But the question is about the 2 headings. Did I get them the right way around? And the answer is yes. Yes, I got them the right way around, which is encouraging, isn't it? So interest first and instalments in arrears. The thing is about financial instruments is they're always instalments in arrears. Okay, so the unwinding table does change in leasing from in advance to in arrears, and from in arrears to in advance. And I got a bit mixed up with that last time I was doing this table. I got them the wrong way around, didn't I? Got the headings the wrong way around. The maths I got right way around. Well, I got everything right this time. The great thing, there isn't in advance, because it would be just too weird to lend someone some money and then demand money back the following day. That would be too weird. So what you do is you lend someone money, and the first instalment comes at the end of the year. Okay, so that's how it works with lending. So you lend someone money, and the first instalment is at the end of the first year. So it's always in arrears. So financial instruments, financial assets are always in arrears. They're always like that. So these are the right way around. Great. Okay. We have a question from Ayan, which is, can you do the double entry? The examiner does not examine the double entry here. He never ever uses double entry to communicate this. If you want to try it, Ayan, please feel free to send me an email suggesting your double entry. But if you're struggling to do the double entry here, then maybe double entry is not your strong suit, and you should perhaps be keeping away from it. If you can't see the double entry instantly, perhaps you're not that strong at double entry, and you shouldn't use double entry to communicate, because the examiner definitely won't be. So don't use double entry to communicate with the examiner on this fella. More of that later. More on that later. But before I go any further, I've got some blue down here that I can utilise. Look at that blue. What I can do is I can skip to financial liabilities. We need to do financial liabilities at some stage this evening, and I say, why not now? Why not right now? The examiner has recently dumbed down his attitude towards FL, and it gives us it gives us a great benefit. So I want to get this in front of you. Have a look at this. FL are carried at amortized cost unless told otherwise. And sometimes you are told otherwise, but usually not. Usually the examiner is silent, and if the examiner is silent about a financial liability, then it is at amortized cost. If the examiner says nothing, the liability is at amortized cost. So basically the way the examiner is seeing this is the bottom of the balance sheet is always amortized cost, but the top of the balance sheet could be fair value or amortized cost, could be amortized cost or fair value, depending on the answer to the two questions. So you do the two questions at the top of the balance sheet, no questions at the bottom of the balance sheet. FL are just carried at amortized cost. Yes, but what does that mean? What that means, of course, is that you would get exactly the same numbers if you were the borrower as the lender gets. These are the asset figures that the lender would get. If you're the borrower, you would have exactly the same numbers, but you would change the sign, of course. So where the guy receiving the money has got a receivable, we have a payable, so we'd have a liability, an outflow and an expense. So it'd be a liability, an outflow and an expense. That's it. So there isn't really a subject, to be honest with you. It's just a flip side of financial assets. Financial liability classification is just John and Travolta again. So we can say C question John and question Travolta. And that's it, we're done. Finished. But of course, we're not finished on financial assets. If you turn over the page, you can see there's financial assets carried at fair value. So here we go, financial assets carried at fair value. FA carried at fair value. And there you go. You can see my heading, fair value. So it already tells us that we have no's in our answer. Let's go and have a look at this flowchart one last time. Let's go and have a look at this flowchart one last time. Here we go. Up we go. I'll just get rid of that very distracting colour. There it is. So let's clean it all up. You can see that in order to get amortized cost, we need 2 yes. But in order to get fair value, we literally just need 1 no. 1 no is adequate. And it doesn't matter which no. I'll illustrate what I mean by that by having a look at the next question. I'll look at the next question before we write anything, actually. So going down to the next question, which is a question blip. You can see in question blip at the top is the title, financial assets at fair value. So we know that we have a no. We know that we have a no, but what no do we have? Well, can you see blip bought shares on the stock exchange for the purpose of speculating. In fact, what we have here is a fail of both tests. And when you have a fail of both tests, don't pick them both out, just pick out whichever one you want to. I tend to pick out the first one as I read, so blip bought. I tell you what, we haven't done that. Should we do that first? Blip bought. Is this a financial asset or a financial liability? Blip bought. Is this a financial asset or a financial liability? Oh, it's an asset. It's a financial asset. Do we do the 2 tests or do we auto amortize cost? Do we do the 2 tests or is it amortized cost? Ah, we do the 2 tests. What are the 2 tests? Cash flow characteristics test, business model test. How many yes do we need for amortized cost? We need 2. How many no do we need for fair value? Just the 1. And we have 2 no's. Because obviously shares, you know, they fail the cash flow characteristics test. There's no return of principal to us. It's not a simple loan. It's just not a simple loan. There's no return of principal. And speculating is the opposite of the collection basis, so we get a no to the business model test as well. So we get a no to the cash flow characteristics test and a no to the business model test. But don't pick them both out, just fail one. Question blip. Cash flow characteristics test. The phrase shares tells us this is not a simple loan asset. This gives a fail. Of the above test and gives us fair value. So we have fair value, and we're going to do fair value now. So off I go doing fair value. So I'm going to have an opening journal. Here is the purchase. And if we go back to the question, we can see Blip bought shares on the stock exchange for the purpose of speculating for 400 shortly before the year end. So we're going to recognise an investment with 400, and we're going to credit the bank with 400. The value at the year end is 330, so there's a fall in value. Here's the fall in value. So I want the investment, which is a debit balance, to come down. So to make a debit balance come down, I credit the debit. And that creates a speculating loss. Which goes into the P&L. And you might recall that the P&L has got four sections under your examiner, which is operating, super exceptionals, financing tax. Do you remember that? Operating, super exceptionals, financing tax. Super exceptionals are big, unusual items which happen very rarely in real life, like Sainsbury's next door, but happen in every single P2 P&L. So there's always a super exceptional. There's always big bad news. The classic example is a tsunami. I gave the example of a tsunami. But a tsunami is a tsunami, and financing is where we're at. Financing, of course, is interest, income and interest expense, obviously. But less obviously, financing is also speculating gains and losses. So this speculating loss goes into a section of the P&L known as financing. Okay. And then we have a closing journal or closing journals. What happens here? So 330, the value rises to 370. So we need the asset, the debit balance to go up. So we debit the debit to make it go up. You can see that the rise in value is from 330 to 370, which is 40. And that creates a speculating gain. Which goes into financing. In the P&L to the tune of 40. But we're not finished yet. And then the asset is sold. When we read the final few words, it says the value rises to 370 a few weeks later when the asset is sold, when the shares are sold. So we need to entirely de-recognise the asset, the investment. And that derecognition of the investment is at the same time as the recognition of cash flowing into the bank. Whoa, hang on, Martin. I thought we weren't doing double entry. What's going on here? Good question. Very good question. Let's go back to the flowchart and append some detail to it. Let's go back to the flowchart one last time, I think. Back up to the flowchart one last time. Here it is. Here's the baby. There she is. So why are we doing what we do? Well, when we are doing amortized cost, we use tables. When we're doing fair value, we use journals. Why do we do it this way round? Is it possible to show fair value with tables? Yes, it is. Is it possible to show amortized cost with journals? Yes, it is. So why do we do it that particular way around? It is, as mentioned earlier, because that's what the examiner does. If you want your answer to look like the examiner's, then that's the way to go. But what if you don't like journals? If you don't like journals, then never, ever, ever use journals, except when you're doing financial assets at fair value, in which case use journals, even though you don't like them. Unfortunately, using journals just in this area is not particularly sophisticated. There's just an uppy-downy rule. The investment itself is a debit balance, and to make the debit balance go up, you use a debit to push a debit up, and to make the debit balance go down, you use a credit to push the debit balance down. So it's not like you have to learn proper double entry, it's just this little limited bit of double entry. But do use double entry when the examiner examines fair value, and he probably will. Great. Which just means that I have to take you back. Notice that what I have done is I have answered the question discuss in full. I'm going to go a bit horrible with the colours, but let's go with these horrible colours. So we really are going heading, sentence, and then journals. And it is commonplace for students to be asked questions in the B section where they're asked to discuss a financial asset at fair value, and all they do is just write down the journals. You can see you don't need to do much in green, but you do need a sentence for the word discuss. If the examiner says discuss, and part B is a financial asset at fair value, then you'll just have a whole load of journals will be your discussion. Journals are a recognised form of discussion amongst accountants. They are a recognised mode of communication. However, exclusively journals doesn't answer the question discussion, so it would be heading sentence journal, heading sentence journal, heading sentence journal, like that. So do you remember the three ways of communicating in the B section? The B section's basically 65 marks of narrative, and the three ways of communicating in the B section are heading sentence sentence, heading sentence numbers, and heading sentence journal. And basically every time you do one of those you get a mark, is the deal. Okay. Right. Wow, that looks startlingly colourful. What I can see, you can see that I'm looking over to the left there now, and I'm looking at myself online. The streaming seems to be very good tonight, so I'm able to see myself there. Great. And you've guessed it, question Bleeny is a copy of Blip, and so is Bling, really, to be frank with you. And what I want to get onto is question Footy, and especially onto question Special. So that's what I'll head for. We're doing quite well actually tonight. We're making good headway. What I'm keen on doing is all of the financial assets and then taking it from there, basically seeing where we go from there. But we're making good headway, and I want to continue with that. So Bleeny and Bling, I'm gonna pop into your homework, and you'll like those. You know the story. It's all there. It's all recorded in interactive. You'll like that. It's just more journals, more of the same. But wait a second. Look, I'm looking at myself on the board over there, and I can see two little letters. What's this thing? What? What's this thing here? Sorry, what? P&L goes in the P. There are two performance statements. The two performance statements are the P&L and the OCI, and like many areas, complex areas of financial reporting, some things go in the P&L and some things go in the OCI. You can see that my speculating gains and losses were going into the P&L. And this is in fact the default and gives rise to the standard abbreviation that you've seen me use before. So I'll give you that standard abbreviation again. It's FVPL. The above investment is often called FVPL, and it is a standard abbreviation for a heck of a mouthful, which is financial asset at fair value through profit or loss. And in fact, FVPL is very often called FVTPL. The examiner usually calls it FVPL, but sometimes he goes for this T and goes FVTPL. There's been examples of answers where he's had one paragraph where he's flipped between FVPL and FVTPL. So whichever you fancy. You'll see lots of references to FVTPL, and if you like the T, chuck it in. But I think it's probably fair to say that most financial accountants tend to use FVPL as written. And this is the default criteria, so unless there's something special going on, then you don't do the other. You do this. This is the default class. But there's another class, you've guessed of course, You can have, fair values going up and down on the balance sheet with the gains and losses being chucked in the P&L, or you can have fair values going up and down on the balance sheet with the gains and losses being chucked in the OCI. But you can only use FVOCI under certain selective conditions. FVOCI. What shall I do with this? I'll just go for this. FVOCI. This applies to strategic equity. This applies to strategic equity. And means this. And you've guessed already, it's fair value, financial asset at fair value gains and losses through other comprehensive income. This applies to strategic equity and means this financial asset at fair value through other comprehensive income. There are two criteria. There are two criteria, and they're my favourite criteria in all financial reporting. Strategic equity must be strategic, and it must be equity. Hooray! And if you have equity which is strategic, then it is described as strategic equity and it is carried FVOC. To be strategic, there must be an intent to keep, and to be equity, it must be shares. And in order to get into this, I think what I'll do is I'll look at special, and we'll make a comparison between special and blip, and I think that'll work quite well for me. Special is very special, and we don't want to go too far with it. But moving on and having a look at special, and the special stuff in special, we can see that, here it is, here's special. You see question special on page 159? So, not getting into it too much. Special purchase equity. Oh, I suppose we should do that. Special purchase, they buy. So is it a financial asset or a financial liability? It's a financial asset. Financial assets, you do two tests, the cash flow characteristics test and the business model test. If it fails one of those, it goes to fair value. But actually there's two forms of fair value. Basically all fair value in real life all goes to the P&L. But in the exam, almost all goes to the P&L, and it is possible for this, gains and losses to end up, the fair value gains and losses to end up in the OCI. That would apply in the special circumstances where we have strategic equity, and the two criteria for strategic equity are the equity must be equity and the equity must be an intent to keep. So let's have a look at whether we have equity. Well, of course we have equity. Obviously we have equity. Otherwise I wouldn't be looking at this example. So there's the word equity. Now let's have a look at the intent. Special purchase equity represents a company that owns music rights that they wish to keep. So we have the two criteria. We have the intent to keep, we have equity, we have strategic equity, and strategic equity we carry FVOC. But do you know what I feel like doing? What I feel like doing is this. It's a little cheeky, but it works for me, and I think it's the way I'm going to do this moment. I'm going to encourage you to have a look at the first question, which was Blip. Blip bought shares on the stock exchange for the purpose of speculating. Can you see that there's very little difference between Blip and Special? Both of them are the purchase of equity. The difference is, as you can see, Blip is speculating, whereas the other fella was strategic. It was an intent to keep. So there is clearly a difference between Blip and Special, and I think I'll highlight that. But I'll how shall I do that? I think I'll write it down. Otherwise there's too much information in your head. Equity assets. The above results in a helpful table. Equity assets always fail the cash flow characteristics test. And so are always carried FV. The above results in a helpful table. Equity assets always fail the cash flow characteristics test, because equity assets are always shares, and shares are never lending, ever. Shares is not lending. Shares is taking a share of the company, and therefore they fail the cash flow characteristics test and are always carried at fair value. Equity assets always fail the cash flow characteristics test, and so always carried at fair value. But this could be FVPL or FVOC. And this table that I'm about to give you here is very cheeky because it doesn't actually exist in the IFRS, but it is a really, really cute way of solving problems very quickly with equity assets. So let's have the two forms of equity asset. The two forms of equity asset are by far the most common, which is the speculative equity asset. I hold shares in Sainsbury's and I'm doing so just purely for capital gain. I'm buying now to sell later. So that would be speculative equity asset. The other one is I hold shares in Sainsbury's, but I'm going to keep these shares forever because frankly, I've got 3% at the moment, and the reason I'm keeping my 3% is I want to buy the other 97% because I want Sainsbury's as my subsidiary. That's called strategic equity, and is very, very rare in real life. And you've guessed, if it's very rare in real life, it's always coming up in the exam. So what changes from one to the other is the intent. The intent to trade or the intent to keep. Notice the Sainsbury's shares are exactly the same in both cases. What's changing is the content of my head. Again, it's all about the content of my head. And that gives rise to different class of equity asset. It's either speculative. Speculative is FVPL and strategic is FVOC. And it's just a really nice way of shortcutting your answers. don't write down the introduction in the examination, but you can definitely write down the table itself. Equity assets are carried like this. There's the table. Now apply it. Equity assets are carried like this. There's the table. Now apply it. So let's apply it in the question special. Here we go, question special. In we go. In we go. So I'll just clean up all that nonsense. And the equivalent nonsense in special, and then off we go. Special purchase equity representing a company that owns music rights that they wish to keep forever. Oi, there we go. So FVOC. This is equity with intent to keep, and therefore is FVOCI. Oh, wait a second, hang on. It's FVOCI. FVOCI, what mode of communication? So we use journals. So we use journals yet again. One last time, yes, one last time. Off we go. So the opening journal, and then off we go. Assuming this is in the B section and therefore we discuss, I'm going to assume that we need sentences. Here we are. So special purchase equity representing a company that owns music rights they wish to keep forever. The cost was 500 shortly before the year end. Here is the purchase. So debit investment with 500 and credit the bank with 500, then year end journal, here is the gain, here is the gain. The cost was 500 shortly before the year end, and by the year end the value had risen to 540, so we want to push the asset up by 40. So we're going to debit the investment with 40, and we're going to credit the gain of 40 into the OCI. And we're not going to do anything clever with the naming of this. How would you describe a PPE revaluation gain? As a PPE revaluation gain. How are you going to describe this strategic equity gain? How about strategic equity gain? But then things get a little more difficult, because what we have to learn is about the process of connectivity between the P&L report and the reserves on the balance sheet. So there's a section of the balance sheet called equity, and that section of the balance sheet called equity has got 4 buckets. They are SC, RE, OCE and NCI. SC is share capital, NCI is non-controlling interest, and the 2 fellas in the middle are called the reserves. So there's the retained earnings reserve and the other components of equity reserve. And retained earnings in this context is nicely renamed the P&L reserve, because this is the rule. Anything that goes through the P&L report is accumulated in the P&L reserve. And anything that goes through the OCI drops into the OCE. So how do we get this gain of 40 into the OCI? The way we get this gain of 40 into the OCI is by putting it into the OCI with that double entry there. The way that we get the gain into the OCI is by using that double entry there. But how do we get it from the OCI into the OCE? It drops in automatically by the process of the computer. The computer just picks up all that gunk in the OCI and drops it into the OCE. That is how the process works. Exactly the same with the P&L, by the way. The computer just adds everything together, compresses the P&L report into a single figure called profit, and then drops that profit into the profit and loss reserve, into the retained earnings. And that process of anything that goes through the P&L ends up in the P&L reserve, anything that goes through the OCI ends up in the OCE is really useful, especially here, because this gain automatically ends up in a strategic equity reserve in OCE, automatically drops in there. And when we get up close to this balance, whoa, it stinks of unrealised. And that idea of unrealised becomes really important when we read on in this very special question called special. Reading on. Then, shortly after the year end, the plans as regards the music changed completely, and the company sold the equity for the year end value of 540. So we have closing journals. Here is the asset sale. Here is the asset sale. We de-recognise the asset at its exit value of 540. And that money comes in at the bank. And finally, here is the transfer. Here is the transfer. Debit, credit. What we need to do is we need to take the gain out of the unrealised reserve. I had it over here, didn't I? Take it out of the unrealised reserve, the OCE, and drop it up into the RE, like that. Just pick it up and drop it. So we're going to take it out, it being the strategic equity gain in the strategic equity reserve. We're going to take the 40 out of the strategic equity reserve within OCE and just drop it straight into retained earnings. And the examiner's absolutely obsessed by this journal. Not entirely unreasonably, but I think he overcooks it for my money, but he is what he is, he does what he does. And because he has such an obsession about this journal, what I'll do is I'll reinforce it in a slightly different way. Oh, I need to have that straight actually. So here we go, nice and straight, there we go. I'll get the green fella and I'll drop it down here. So maybe I'll use a little bit of green just to give you that flow of colours. So down here, what we're going to show is how this affects the presentation. So the way that this affects the presentation in equity is as follows. So using the abbreviations, we have S, C, R, E, OCE, other components of equity, and NCI. Those four, when added together, they are called equity. And as accountants, we are romantic people. When we don't know a number, we give it a kiss, like that. And this 40 here, what it's doing, I'm going to go completely crazy now and go red to really, emphasize the movement, is just moving 40 million, just $40. We're going to move $40 from one to the other. And what does this do to the overall size of equity? Well, as you can see, the overall size of equity is unchanged. What does it do to the reserves? Well, the overall size of the reserves is unchanged, but one reserve goes down and the other one goes up. And that transfer is compulsory. It is required by IFRS 9. It is compulsory. You have no choice. But actually, it's a positive thing as well, because there's a strong culture of your maximum dividend is your retained earnings. And obviously, if we do this journal, we make the retained earnings go up and it makes the company look more healthy. So it's a positive thing as well. But positive or not, it is required. Great, there you go. And we have finished financial assets. That is it for financial assets. You can see that there's a little question at the bottom there, which, looking at the time, we have time to have a little look at. But that's it for financial assets. So let's have a look at the chat at the top there. Please explain the OCE to RE journal again. Why we need this. The OCE to RE journal. Because it's the law. Why we need it? Because it's the law. What's the law called? IFRS 9. There is a limit actually to the depth of explanation that can be given, because the ISB themselves are not entirely convinced that this ancient culture of realised and unrealised is anyway meaningful. But there is this messed up, try not to say this in the exam. Try not to say this in the exam, because you'll only annoy markers, and it's very difficult to phrase. It's highly laden with politics, but it might help you, Ahmed. So here is some ancient misfitting philosophy. These two here, didn't press hard enough. These two babies here, they're called reserves. Okay? And there is law around the world that uses this word realised and unrealised. And there is a culture, it's nowhere in the IFRS, but there is a culture in corporate reporting of interpreting this as realised and that as unrealised. And research has been done by the International Accounting Standards Board to try and find out what these words mean. And the ISB have been unable to find out what these words mean. The first bit of research that they did was around about 1997, and they recently spent a couple of years, just finished last year, doing some research into these words and trying to find out what these mean. There is no evidence that they have any meaning, and the subject is enormously complex and was the subject of the current issues exam from June this year, so you don't need to go too much into depth here. But there's something around the idea that unrealised are gains that will never turn into cash. And if it's true that the strategic equity you're going to keep forever, then the gain of 40, when we make the 40, looks like it's unrealised because it looks like it'll never turn into cash. But then it does turn into cash. So what happens to the underlying nature of this gain? It goes from being unrealised to being realised, and therefore we move it from one bucket to another. And even though the ISB make no reference whatsoever to realised and unrealised in IFRS 9, and they do require this journal in IFRS 9, even though they make no reference to unrealised and realised, you can see that there are flavours of that ancient stinky philosophy being utilised within this modern IFRS. So that's where it's coming from, Ahmed. Okay, good stuff. I'm happy. We have now completed financial assets carried at fair value. Hang on, what about this little one at the bottom? Well, this little one at the bottom is a special little deal. It's called the FVO, the fair value option. And I'll tell you a little bit about the fair value option. And then we'll do the question. So I think I'll just have a heading and we'll go for it, guys. So, here we go. Question FVO. And all I'm going to do is just wave my hands around for a bit and then we're sorted. All I'm going to do is just wave my hands around for a bit and then we're sorted. The FVO is an abbreviation for the fair value option. And the fair value option is a solution to a problem. The problem is called the accounting mismatch. The accounting mismatch happens when you've got an asset at the top of the balance sheet and a liability at the bottom of the balance sheet, which are related to each other, but somehow one of these guys ended up on amortised cost and the other one ended up on fair value. Could be either way around. One of them ended up on fair value and the other one ended up on amortised cost. Could be either way around. Now the graphs for these two are very different. The reason I call that question John Travolta is if you draw out a graph of the movement of amortised cost, it looks like John Travolta dancing. It sort of does this. You can tell by the way I use my walk, I'm a woman's man, no time to talk. It's a mathematical thing. It's a rather lovely curve, very feminine curve, this curve that you get from amortised cost. Whereas the fair value is like a drunken spider. And if you have two related fellas, one at the top of the balance sheet and one at the bottom of the balance sheet doing completely different graphs, even though they're basically the same thing, then that's a mismatch. And the name for this mismatch is called mismatch. And the solution to the problem is called the FVO. So there's two things to learn: the problem, the mismatch, and the solution, the FVO. There are two things to learn: the problem, the mismatch, and the solution, the FVO. And that's it. And now we do it. Let's go. So here we go. I'm going to bring up the question. So FVO. So it's still roughly in the same area, but we've moved on. FVO is a bank. FVO has a financial asset carried at amortised cost in the draft financial statements for the current year ended 31st of March. The asset is correctly carried at amortised cost. So the asset is at amortised cost because it fulfills both the cash flow characteristics test and the business model test. However, it has been noticed that a very similar liability is being carried at fair value. This means that on the draft FS, there is an asset on the top of the position statement that is being carried at amortised cost that is very similar to a liability on the bottom of the position statement being carried at fair value. And discuss if there is a solution to this problem. There are two questions basically. We're required to identify and name the problem and identify and name the solution. And that's it, that's our 2 marks, that's all it is. It's a lovely little subject, doesn't get examined very often, but when it does, it's just nice straight marks. Pure learning. So I'm going to write down the answer, here we go. The problem. The problem is called the accounting mismatch. And occurs when a related FA and FA and FL per are carried under different systems. And in this case, we have the FA and the FL as follows. It could be either way up, but in this case, the FA was passing both of the tests and being carried at amortised cost. Whereas we are told that the FL is carried at fair value. Oh, that looks like a mismatch. Exactly, it's called the accounting mismatch. I'll actually put that in quotes, you know, because it's a special phrase. It's a proper noun, I believe, is the way of describing it. So the problem is the accounting mismatch. So 1 mark for spotting the problem, the other mark is for suggesting the solution. The solution. The bank can carry both at fair value. Ta-da! And that is called the fair value option, or FVO. Very, very frequently abbreviated to FVO. Oh, hang on, it's called the fair value option. Ah, yes, because the bank can, but doesn't have to, carry both at fair value. Ah, it's called the fair value option because the bank can carry both at fair value. Obviously, if you carry both at amortised cost, that would also remove the mismatch, but that is not an option. You can either have, you don't, if you have a mismatch, you can just leave them mismatching, it's okay. But if you have a mismatch and it's bothering you, it's driving you nuts, then you can take the one that's at amortised cost and turn it into fair value. You can have both of them at fair value, and that's the deal. And, you know, it's been examined a couple of times, hasn't come up for a couple of years, so it is long overdue. I must admit it's a small little subject, but the examiner's going to examine it sometime soon. I imagine in the next year, whether it comes up in December, I don't know, but it's a lovely little one. Which therefore brings us to the end of our course. Abs, yes, I can just very briefly repeat the fair value option, of course. If you want to just check it out on the recording, if you wish to see it again, the recording has been successful. But the fair value option is an option that the bank has, and the bank can use this option to solve a problem. The problem is when you have a financial asset and a financial liability under different systems. One of them is amortised cost and the other one's fair value. When you have one of them at one value and one of them at the other value, that gives a mismatch, which can be uncomfortable. If it doesn't bother you, then just leave it. But if it does bother you, the solution to the problem is have both of them at fair value. And the name of that solution to the problem is called the fair value option. And there you go, there it is, just highlighted in blue and yellow over my shoulder. Well guys, we've come to the end now, and this is the end of the course. But first of all, it's also the end of chapter 12 for now. And chapter 12, you know, it does go on. We've covered, you know, the stuff that comes up 8/10 of the examination, but we haven't had a look at some of the other stuff that exists in the IFRS, and I do want you to have a look at that. So I'm going to introduce some of the other subjects to be explored in greater detail at your leisure. So I'm going to take you to the notes. The next thing over the page you're going to really like. It's called fair value measurement. That's a really nice one, this, and it's frequently examined. It's not challenging, it's not difficult, and it's got some lovely recordings down in the in the library there, so have a look at those. There's a lovely little question just here called Gambit, where you play a little game of spot the level. There's 3 levels to FVM, and you play spot the level. I think you'll enjoy that. That's good stuff. Then you have the challenging subject of impairment of financial assets, which we discussed thousands of years ago now, back in Evening 4. And this subject on the impairment of financial assets is quite a big subject 4, you're sitting potentially, it's you remember that the top tip as regards question 4 is revenue recognition, and that is red hot. Make sure you get back into revenue recognition, which we did both on evening 4 and again on evening 5. I'd really encourage you to, go a bit crazy with revenue recognition, but there is the possibility maybe that you'll be having a look at impairment of financial assets. Now, it's quite a challenging subject, and I introduced it in evening 4, and I'd like you to go back and have a look at that in evening 4. It's very, very, very unlikely to come up in the, well, who knows, but it's very unlikely. Who knows? But it's unlikely to come up in questions 1, 2 or 3, in which case it would be examined as a current issues question, which is why we looked at it when we were doing current issues. Now, we've had a look at it in current issues, but you know what I'm going to say here. We're coming to the end of the course, but that doesn't mean it's the last time I see you. We're leading now into revision, and that's what I'm heading towards for the last few minutes that we spend together. When it comes to revision, I want you to go back and make sure you're happy with evening 1, 2, 3, 4, 5, 6, 7, 8. Make sure you're happy with all of the basics. With that 16 hours that we've done together, we've done, the central homeland of P2, and, for the moment, just try and stay out of the dark corners as much as you can and get better and stronger and better at the homeland of P2. Included in the homeland of P2 is the impairment of financial assets as a current issue, which is recorded on evening 4. So go and have a look at that. Then we got the tricky subject of hedge accounting. Hedging is a real mixed bag. Hedging itself is very sophisticated, and then the accounting for hedging on top of that is quite a big jump up. So hedging really is starting to be into the dark corners. So I'm not saying don't do hedging. But don't do hedging until you're confident with the rest of the heartland. Okay, so hedging is a bit of a bottomless pit, to be honest with you. There are huge books that have been written about hedging, many of which are on my wife's bedside, because my wife is a specialist in hedge accounting, and she's only got 4 or 5 books on her bedside on hedge accounting. There are hundreds of them, literally hundreds of them, on hedge accounting, not on hedging, but on hedge accounting. So it is a bottomless pit of a subject, and it can really suck you in. So if you want to get a little bit of a feel for hedging, then go into the library, but don't spend too long in there, and don't let yourself get sucked in, because hedging is a real challenge, and it's very rare that students who even study hedging score very highly in that subject. So pull back from that. Which brings us therefore to the final chapter, which is deferred tax. Here's the title coming up. Tax, actually, the IFRS on deferred tax calls the subject simply tax. And that is what we're going to do together when I see you next time, which is not tomorrow, but a week tomorrow for the mentoring session. We're going to spend 30 minutes together, 15 of which I'm going to do on deferred tax. But I haven't quite finished with you yet, because what I want to do is to summarise some details. The first thing I want to do, however, before I go any further, is I want to make sure that you've got the dates for revision. I heartily encourage you to get yourself on revision. Many of you guys are already. But just to reinforce those dates, make sure you're absolutely fine. There are 4 sessions of revision. Revision comes in 4 sessions. And the dates are as follows. There's only 2, which sounds a bit mad. It's the 19th and just next door, the 27th. It's actually a Thursday and a Friday this month. It's actually a Thursday and a Friday. Now, the reason it's worked out like that with 4 sessions is we have an afternoon and then an evening, then an afternoon and an evening. Now, there's a lecture sequence already up a study planner already up on the revision product for you guys that are on revision. The sequence gives advice on a document called the revision pack, which is a wonderful thing to start getting into now. It's got loads of articles and loads of questions and loads of great stuff. And it also tells you what you've heard me say before, which is on revision, we're going to do questions, questions, questions. The deal is basically that over those 4 sessions of 2 3/4 hours each session's 3 3/4 hours, just under 3 hours, we're going to do 2 questions per session. So in the first one we do 2 question 1, then we do 2 question 2, then we do 2 question 3, then we do 2 question 4. That's roughly how it is anyway. So it's 2 questions, 2 questions, 2 questions, 2 questions. That is the flow of how we're going to utilise that time. That's essentially the idea as to how we're going to utilise that time. And you can imagine I'm picking, the questions that I think are most likely to be examined in December. And that is the basis of revision. But now I'm going to take you to the idea of revision itself, that there are 2 phases to revision. The 2 phases to revision are like pre-revision, revision, and then revision for the exam. There's revision for revision and revision for the exam. Now, whether you are on a revision course or not, my advice would be go through the same process. There's no doubt about it, P2 exam does have lots of application, but it also has lots of knowledge. So what I want you to do for the next week or so is to consolidate your knowledge. Go back over chapter 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13. Go back through those chapters and reinforce your knowledge so you really know what you know. And once you're, solid with your knowledge, then you get into the exam questions. If you're with me on the revision course itself, then the detail of the questions that I recommend that we go through, well, we'll be dealing with that when we're together. So, if you're on the revision course with me, just hang fire from doing too many revision questions because they are really, really scary, to be honest with you. Let me guide you through the revision questions and then let you go. You do have to do exam questions yourself, you do, but if you're on the revision course with me, let me guide you through that process, get you started, get you on your feet before you try and start to run. However, if you're not on the revision course with me, you might find it useful to have a look at some information you've had from the very start, which is in the class notes. If we go right to the very, very beginning of the class notes, then you will see that there's a little introductory chapter. And actually in that introductory chapter, we have some sequences for the revision. There's your revision, and then there's the full-time sequence, and then there we go. There's a couple of draft revision sequences that I have been using for the 2-day revision and the 4-day revision there, and they appear on page 9 of your class notes, and also on page over the page on page 10 of your class notes is the classic must, could, should. All of these questions that are referenced here, they're all in your revision kit. But there is, I think I just have to say this again, I've probably said this many times, but I think I should say it again. When it comes to the revision kit, there are 74 questions available. There are 74 questions available. Make sure you do question 31 onwards. It's question 31 onwards. Make sure you do the more recent questions. Now, there's nothing fundamentally wrong with the older questions, but the older questions are older. The more recent the question, the more useful it's likely to be, which means, to be honest with you, when you're using the revision kit, one of the best ways of doing it is start at question 74 and work your way backwards, 74, 73, and all the way down to question 31. So the more modern questions are the more useful. There are 44 questions in the more modern style. If you can do those questions 4 times, then that's fine. But do not do any of the older questions from question 1 to 30. Do not do any of the older questions from question 1 to 30 until you've done the modern questions from December 2007 onwards, at least 4 times each. There's 4 of them, and doing them 4 times each, well, that's a big ask. Okay? So stick with the newer questions, you'll get much more value out of them. All right? But coming back to the ideas that I was just doing there, for those of you that are on the revision course with me, I want you to revise for revision by practicing your class notes. And then once you're on revision with me, then I will show you your way around the examination, and then you can go free. For those of you not on the revision course with me, follow the same process, but use the questions that I've just shown you up there. So do a bit of revision of the class questions and then start on the revision kit. And the revision kit, look at the more modern questions first. Okay? So question 74 backwards. Great. So just dealing with a couple of questions. Couple of questions that I don't really understand, so please feel free to email me if you have any questions. That I'll try and rephrase them as well. But BK Sam, I fully understand that question. So all the questions from question 31 onwards are past exam questions. The revision kit is all past exam questions, to be honest with you. All past exam questions, all 74 are all past exam questions from this current examiner, which is called Graham Holt. So Graham Holt's written all 74 questions. They're all Graham Holt questions. But there was a slight change in style in 2007, and there are 44 questions from 2007 onwards, and they're in the modern style. The old questions are not bad, they are Graham Holt, and they still possess some of the flavour of his current style, but they're just not as good as the new questions. So all 74 are all real Graham Holt questions, but the newer ones are better because they're newer. Why are the newer ones better? Because they're newer. That's why. You'll get much more value out of the more recent questions. That's the real reason, BK Sam. Great. Okay, guys. So I guess I should go to the slides one last time and say to you, well done, guys. You've done financial instruments. There's lots more on financial instruments. There's a whole career on it. My wife has now been doing financial instruments for the last 10 years and she still learns things every day. So there's plenty to learn. But make sure you do the basics. Make sure you can account for financial assets and financial liabilities. That's the essential stuff. There is other stuff down in the library that you can have a look at, but the most important thing is getting the ideas of amortized cost and fair value and being able to do the tables and the journals. That's the real key. That's what's guaranteed in the exam. You're guaranteed to be doing financial assets and financial liabilities. Whether you might be doing other stuff as well is possible, but you're guaranteed financial assets and financial liabilities. Maybe 4 financial assets, just to reinforce, there could be 4 of them waiting for you, not 1, but 4. So you could be doing the cash flow characteristics test and the business model test 4 times in one exam. Possible. So make sure you're good at the heartland of financial instruments. Also, make sure that you are good at the heartland of all the corporate reporting that we've done together. It's been a pleasure to teach you over the last 16 hours and an extra 10 minutes. And I very much look forward to seeing you on revision. Work hard, and I hope to see you on revision. Good luck. Good luck. Good luck with your pre-revision. Good luck with the exam. And I look forward to seeing you soon.